Well, it's my pleasure to welcome us all back now for a discussion of bank charters, bank regulation, and the future of FinTech. And the moderator for this panel is my friend and colleague, Professor Paolo Seguto. He's an assistant professor at George Mason University's Antonin Scalia Law School, specializing in financial regulation, regulation of banks, securities, and derivatives, international financial markets. Before coming to the Scalia Law School, he was a research fellow at Georgetown, NYU, and the London School of Economics. Paolo, thank you so much for joining us today.
Thank you, Adam, and thank you all. I wanted to try and to show that Italian can start things on time, but I failed. So we are 10 minutes late. Okay. So it's a great pleasure to moderate this fantastic panel. The after lunch panel is always tough, but the topic is so sexy and hot that it's going to be a very easy panel for me to moderate. So the panel is on the role of the administrative state in granting access to the provisions of banking services. And David Zering was a professor, associate professor in legal studies and business ethics at the Wharton Business School, wrote an excellent piece that looked at the evolution of bank chartering before and after the financial crisis and provides some very interesting analysis of the FinTech Charter that the OCC rolled over a few years ago. So David is going to start the panel, and then Tom Curry is going to follow.
Thanks. It's a pleasure to be here. So I want to talk about the motivation for this paper, and it comes a little bit from academia and a little bit from the real world. I spent very little time in the real world, but I'm going to give it a shot this time. So a number of legal scholars have talked about the importance of sort of using charters to constrain banks, or maybe turning them into instruments of public policy, say directing their resources to underserved communities or towards national industrial priorities. And I associate this most with Bob Hockett and Sally Omarova, but there are other authors who talk about the charter as something that imposes obligations or could be used to impose obligations on banks. And I think of this as a sort of contraction of the charter, an imposition of regulation. So you can see Morgan Ricks talking about that issue. And it's not just academics. William Proxmire long ago talked about how a public charter conveys numerous economic benefits, and in return it is legitimate for public policy and regulatory practice to require some public purpose. So this is a story about banking that based on a charter vision that would use the charter to sort of really merge the public and the private when it comes to financial services. And then you have a different approach taken by the OCC itself, who, when Tom Curry was the comptroller, proposed and eventually has been in the process of beginning to implement a process of charter expansion beyond banks to fintech companies. The acting comptroller in 2017 said the virtue of bringing technology-oriented financial companies that provide banking services out of the shadows. So if the agency is talking about expanding the charter and academics are talking about sort of restricting it or repurposing it, it seemed like a good time to take stock of what the agency is actually doing. There seems to be something of a disconnect in the practice of the charter, of the agency as revealed in its charter application processing, and in particular in its denials, and then the way that chartering seems to work these days. If you look at what the OCC has said when it especially rejects charters, it looks like it's deferentially trying to grant charters and applying a fit and proper test to the would-be managers or promoters of the charter of a newly chartered bank. When it can't conclude that they are the type of people who should be running a bank, it rejects their application to do so. However, what we'll see is that the number of new charters granted by the OCC and really the new charters granted by any regulator has gone down dramatically over the past 10 years in the wake of the financial crisis. That's because it looks like both the OCC and the FDIC, when it comes to charter applications, are very interested in the business model that the charter proponents have. And if they're unsatisfied with the quality of that business model well, and they've been generally unsatisfied in the past 10 years, then they either slow walk the charter's application or suggest that they'll recommend that the charter be rejected, the charter application be rejected, and give the charter applicants an opportunity to withdraw their application before that happens. Okay. And then there's a sort of special purpose charter that the OCC is practicing. And here I think you could tell a story, and I'll try not to tell it for too long, about how chartering fintechs really seems to challenge the traditional supervision between banking and commerce that the OCC and its governing statutes have always insisted upon. Because some of the largest money providers in the fintech space are commercial companies like Amazon, Google, and Apple, all of whom have wallets or payment systems that might really benefit from a national preemption of state money licensing charter obligations, and that have a peer in China that's an absolutely enormous and very valuable fintech worth $150 billion at last count, making it the second most valuable fintech in the world. I guess Uber just got valued at $160 billion. But that's an interesting sort of threat to the idea that banks are different and should and must be different from commercial companies. But I think what we see in the way that OCC is rolling out the FinTech Charter, and I'll look forward to hearing from the panelists on this, is that in fact that's not really how OCC sees the Charter. It sees the FinTech Charter as something to be offered cautiously to FinTech-only firms that are only in the FinTech space, and proceeding from there. Okay. Of course, there are problems. I've alluded to one of them with the nature of this sort of study. It's easy to observe chartering decisions, but the relationships before and after the charter are much less observable, and in the case of banks, very, very important. And then also, we don't exactly know where the FinTech Charter is going to go. As of July 31st, the OCC opened for business as far as accepting applications for a special purpose FinTech Charter. But so far, it hasn't granted any, and there's some indication that it has received few applications. There's legal risk to the OCC's FinTech Charter, as I think we'll hear about over the course of our panel discussion. And so we'll see what happens. But I wanted to start by talking about the actual practice of the OCC and then turn to FinTech Charters and then hear from the rest of our panelists. Okay, so the actual practice is that applying for a national bank charter is very complicated. And if your model is applying for a corporate charter, that's trivially easy. Bank chartering is a much more intrusive and a complex process, and the OCC has made how it takes to go get a national bank charter relatively public, so we can see that. The express chartering decision is, as I suggested, best understood as a fit and proper test, but there are some unwritten components to the chartering decision that have made obtaining a national bank charter to be very difficult. And so here we go. The OCC insists that, why might you want a bank charter? Well, you can enter into the business and banking, and then also you preempt state consumer protection laws, at least to some degree. That's changed since Dodd-Frank. And you get one regulator, as opposed to a state regulator and the FDIC. The OCC is your regulator. The FDIC doesn't regulate you if you have a national bank charter. You may have to deal with the Fed, but you may be able to avoid that. And so that may be attractive to would-be charter holders. So in order to get a charter, though, you have to comply with the requirements of the OCC's chartering manual. That's a relatively extensive document. What happens when charters are granted or denied by the agency is a relatively cursory decision. Here, for example, this is just an application by a thrift to become a bank with a national charter. And this is the entire discussion section. There's not a lot of law cited or a ton of analysis. And then there's the proposed operating subsidiary is permissible, consistent with the requirements of our regulations, and that is that. Nonetheless, there's much more that goes into the chartering application process. And so I took a look at the application of a would-be online lender that wants a national bank charter. It wants to take deposits. That's Vero. it hired Sullivan and Cromwell to take it through the chartering process. It's raised $100 million approximately. And it got a conditional approval from the OCC, but its application was, about 100 pages long. There's lots of redacted documents which we can't see. And there's a comment period that was instituted after Vero filed its application, and it just withdrew that application because it just got conditional approval of the charter from the comptroller, but withdrew its application for deposit insurance. So it may be refiling for that next year. We'll see. But this suggests that right now Vero is going to have to continue to operate in partnership with an existing chartered bank, which is how it's handling its relationships with customers who want to deposit money with it today. I also looked at a particular lawyer at Wachtell Lipton who handled a relatively sensitive divestiture of an insurance of a subsidiary for a chartered bank for MetLife in an effort for MetLife to avoid designation. But she also handled, a relatively simple to me seeming acquisition of Brown Deere by a mid-sized Milwaukee bank company. And so, this just suggests that people, who want to do something with charters often pay, high-value legal talent for the opportunity to do so. Okay, so what about charter denials? So I read all of them since 2003. There were 5. So it was a noble effort. Again, I come back to this idea that it looks like the agency focuses on fit and proper sort of analysis. So 1 weak proposed officer might be acceptable, but a few weak inexperienced managers, that's a reason to deny application for a bank. Senior executives to compensate for leaner banking, limited banking experience, and our assessment of the senior management team of the proposed signature bank is that they fail to meet this requirement. There's a relatively lengthy denial where there's some suggestion that, that the bank may have a hard time complying with the AML, anti-money laundering requirements that the agency. There's an acquisition denial here where basically the OCC seemed to fret about the ability of the bank to operate a credit card business, which it would have had to do if it had acquired the bank. So there you go. That's a bunch of denials, and that's basically all of them. And so what you see is this relatively short and to the point decision at the point of decision where a charter is granted or denied. But that's obviously not the entire picture. For what we see is that applications for new banks to the OCC have essentially gone away. And we can also see, if we just look at the number of approved banks, even before the financial crisis, is that that number is much smaller than the number of applications received. So something's going on before the point at which an application is agreed to or denied, and that deters applicants. There's a lot of withdrawals. Something similar is going on for charter conversions. Okay, so let me talk briefly about the FinTech Charter, which I think Thomas Curry really has shepherded into existence. And I've given you my basic point. It could be really momentous if PayPal had a bank charter, right? Even a special purpose bank charter. And Ant Financial, which does have an online bank charter, it can't do everything in China. It's this absolutely enormous financial company. And where did it come from? It's Alibaba is the Amazon of China's payment processor. So they spun it off, created a FinTech charter, and that's potentially what we're talking about here. That's why one thinks about Apple and Google and all the online payment processors and whether they would benefit from national preemption and a single regulator. But practically, what I suspect I see with the OCC is that it's a relatively conservative effort to get into the job. So a number of financial regulators are being interested in FinTech firms. And the OCC is, I guess, no different. It developed this way that it would go about evaluating charter applications. There's quite a bit of detail in this manual, which it supplemented. And as I said, on July 31st, it announced that it would start accepting applications for FinTech charters. Nonetheless, the agency has moved very cautiously when it comes to offering charters to special purpose banking companies. So though it's talked about it beforehand, I think its most recent set of rules is a 2003 regulation. Since then, it's created sort of opportunities for subsidiaries of existing national banks to do credit card operations, trust operations. During the financial crisis, it made an allowance for some shelf charters, so would-be investors could bid on a failed bank and pull a charter down off the shelf and get going that way. What you can see is that not that many of these charters have been instituted. With trust company charters, the agency may have largely stopped. So what do we make of this? I think that may be a good thing. If the OCC was thinking about chartering the Amazon payment systems of the world, that would be something that really would end the separation of banking and commerce, and seems to me like something that Congress should do. But I also think that the chartering process that the OCC engages in really doesn't look like it's public policy oriented as some academics think it should be. I've told you about my commerce takeaway, and then this picks up on Commissioner Olthausen's thing. I think one of the interesting things about this, and one of the reasons I wanted to talk about OCC, is that we've had these stories of hair braiders, and there's those poor monks who were told to stop building caskets. There's the DC tour guides who had to get professional licenses. And in some ways, looking at bank licenses is a good test of the licensing process, because banks are definitely dangerous, right? When they blow up, people get hurt. And most people think there should be a licensing process and system and work. And so it's interesting to study how it actually works, because I think that sort of puts the when is licensing appropriate question to a particular test. So thanks very much.
Our next speaker is Tom Curry. Tom is currently partner and co-leader of the Banking and Financial Services Group at Nutter, McLennan and Fish. Before joining the private sector, he was controller of the currency between 2012 and 2017. I remember it was the fall of 2016 when at Georgetown you launched the white paper on OCC. I was there, and today we are super excited to have you here.
Yeah, thank you, Paolo. So you're a groupie, huh? I want to thank the Scalia Law School for inviting me today, and I want to compliment David on a very well-written article and a presentation today. Thank you, David. I thought I'd give a little background as a practitioner in the regulatory side. In my career, I served as a chartering authority for 27 of my 30-plus year career as a bank regulator. And I use the term chartering authority because it is an important distinction among the bank regulators, especially the federal bank regulators. The underlying purpose for chartering an institution is really to promote economic development and to fill a void where credit is not readily available to businesses. That's a distinct difference in mission than the Federal Deposit Insurance Corporation, which is an insurance company and is much more conservative as a result of its statutory obligation to protect and preserve the deposit insurance fund funded by bank assessments. A couple of observations about traditional banks and then also the OCC Special Purpose National Bank Charter. From a traditional bank standpoint, I agree with David that it is generally once you're in the process, charters are readily available. The process itself involves a lot of front-end discussions and preparation with the chartering authority, whether it was the OCC or in my past career as Commissioner of Banks in the Commonwealth of Massachusetts. There's basic statutory requirements that the agencies are looking for. Foremost among those, I think, are capital management and the business plan. And the business plan has become much more an important consideration since the successive banking crises of the last 30 years. Is it a viable business plan and that is supported by adequate capital? And is there an experience level that in the management of the proposed banks that will allow it to have a reasonable chance of success? One of the things that I would point out in terms of the dearth of, or the number of charters that are issued in the time period is that you have to look at the economic context. I think that drives a lot of the volume for bank charters. In economic boom times, there's usually an increase in the number of bank charters. When you have a contraction, there's less of an interest in chartering a bank, and it also is easier to effect by buying an existing franchise that may be troubled. You have the advantage of an infrastructure already being in place and not having to build out the necessary internal controls and functions of the bank. And that's, I think, was the story up until recently in terms of the number of bank charters being awarded by chartering authorities, that there was an abundance of weaker banks that could be acquired at a much cheaper cost and less of a headache. The other factor is the regulatory environment. I mentioned earlier the difference between the OCC as a chartering authority and the FDIC. The FDIC was burned by a record number of bank failures in this last crisis. It was the first time in the history of the FDIC that the fund balance went well into the negative territory in the red. A lot of the failures in the Southeast and the Southwest were attributed to a weak business model. In some sense, in some respects, especially in the Southeast, where you had a lot of bank consolidation, you had bank executives that were able to cash out, had available capital, were young, and wanted to continue a banking business, and with the idea that they would sell it off and reap a second potential financial windfall. That is borne out if you look at the material loss reviews that the inspectors general of the agencies put out. It was basically originate the charter to flip it, set up. It relied on, in many cases, relied on volatile sources of funding and was heavily concentrated in commercial real estate. So those are external factors. In the chartering decision, there are some other considerations that an agency is required to address, competition and public convenience and advantage criteria. On the competition side, and I was talking to Tom Vartanian earlier, we are in a remarkably different spot than they were a generation ago or 40 years ago prior to Reg Q. The competitive assessment was really to make sure that you didn't damage the franchise of an existing bank. That is no longer the case. The presumption is that new entrants actually improve competition. The other factor is public convenience and advantage. That has been translated effectively through practice into making sure that a applicant has a CRA statement that will indicate how they will meet the credit needs of their entire community, including low to moderate income neighborhoods. The public convenience standard, I think, also, depending on shifting policies, could be used to require more in terms of public benefits in the chartering decision. But up to now, the general sentiment among the regulators and longstanding practice is not to make those requirements. I think you could see some states emphasizing that going forward, but as of now, that's not the practice at the federal agencies. Switching to the OCC Special Purpose National Bank for FinTechs, I'm extremely pleased that my successors, Keith Naraika and the current comptroller, Joseph Otting, embraced what we started at the OCC under my tenure and issued the manual for chartering FinTechs, and after getting support from the U.S. Treasury's report on innovation and FinTechs. I certainly wish it would have been sooner, and I certainly wish that it was not met, it was met during my term with litigation, which has really slowed down a necessary innovation to actually pursuing and granting charters. And as David mentioned, I think the first applicant has to be prepared to go through the gauntlet, which probably will mean that it will be an applicant of some substantial resources to be able to go through that process. They will be, I believe, strongly supported by the Comptroller's Office in any litigation. So why did the OCC do this? In my view, we already have fintechs in the banking industry, but it's done indirectly. It's done through third-party agent banks. By having it not be out in the open or transparent, I think you run risks of having a situation where you have a rent-a-bank charter situation. So my view was, let's bring them into the open. Let's not have a small bank, giving the example of a payments firm, fintech firm, running millions or billions of dollars worth of payments through a bank that probably has $10 million in capital. It would be much better to actually charter that entity, come at it what is an appropriate capital level, and have it out in the open, subject to appropriate levels of supervision. I think the charter initiative also raises the question, which David said, what is a bank? Again, I think as comptroller, I was satisfied with the quite in-depth legal analysis of the OCC's lawyers, who, since Tom, have been very quite much accomplished lawyers. We assessed the litigation risk, and certainly based on the OCC's 2003 regulation, that it would be appropriate to charter a fintech firm that did not take deposits. One last comment, David mentioned the Vero Bank application. I think that's significant for a couple of reasons. The fact that the OCC issued a preliminary approval indicates that they believe that business model is a sound one or a viable one. I think that's very important. I think that's a signal to the fintech firms that the OCC is comfortable with the model. And then finally, I think it's significant that the OCC went forward without the FDIC. The practice of the agencies was to coordinate chartering decisions where there was a full-service applicant with FDIC insurance. The fact that the OCC went out unilaterally indicates that they are going to force the issue, and it really is up to the current FDIC chair, Yelena McWilliams, to make the call whether that type of business model poses an unacceptable risk of loss to the Deposit Insurance Fund. Thank you.
Thank you so much, Tom, for your comments. Now, Heidi. Yep, wherever you want. Yeah. So Heidi Schuner is professor of law at Columbus School of Law at the Catholic University of America. She's a prolific scholar in the banking law field, and before joining academia, she practiced and she served in the government. So Heidi, thank you so much.
Thank you. So Paolo, the Italians start late, the Greeks speak with their hands, and I don't want to hit the toms on either side of me while I'm talking. So Adam, thank you so much, and Paolo, thank you for having me. And David, I really enjoyed reading your paper. David's paper very broadly asks us to sort of re-envision chartering as a regulatory mechanism, sort of in a more holistic way that I had really never thought of it that way. I'd always thought of chartering as sort of the key to the door, the expensive entry restriction, and I really enjoyed pushing myself to think about chartering in a much broader sense. More narrowly, David, as he discussed, talks about the OCC's chartering decisions, and I'm going to focus on the OCC charters, and I'm going to, in my brief comments, I'm going to ask sort of a provocative question, but it's one really that I am sort of struggling with, and maybe the real lawyers will answer all my questions. But my real question is, why in the world would anyone want a de novo federal banking charter? I just really am having a hard time figuring out who these people are. And so it doesn't surprise me when David shows us that the comptroller has rejected some applications based on fit and proper standards, because who are these people that want de novo bank charters? So I'm going to talk about the traditional bank charter and then the special purpose FinTech Charter. So with regard to applying for a de novo regular deposit-taking charter, sort of as Tom already pointed out, there's so many reasons not to do that. With interest rates remaining very low, the traditional model of making money on the margin, on the spread between interest rates, is just not as lucrative as it once was. And so it's a lot harder to make money as a bank doing what traditional banks do. Again, as Tom mentioned, the regulatory environment is daunting, so it's an expensive business to get into. And then I get, from sort of the perspective of my students, it just seems like traditional banking is boring. So if you're going to start a brand new business, why would it be a de novo traditional bank? Why wouldn't you go for something more exciting as that entrepreneur? So that brings me to the OCC SpecialPurpose National Bank Charter, and I think of it as a really great study in major trade-offs in terms of coming up with this kind of mechanism to provide FinTech businesses with access to banking. So let's start with the premise that these charters really rely on, as Tom mentioned, and that is that they're not going to be deposit taking. As I'll talk about in a minute, I think it's an essential part of this scheme is that they not be deposit-taking institutions. But also, I sort of look at that and think, what's the point then? Why would you want to be a bank and not get access to that subsidized source of funding, the FDIC-insured deposit? So it sort of seems like it's October, so forgive me, but it's like buying expensive World Series tickets when you're not a baseball fan. Like, I don't really get it. So there's that. And then in addition to that, we have to keep in mind that that special purpose national bank is still going to be restricted in its activities. It's still going to have to probably, although I'm not entirely clear on what the OCC intends with this, but probably will have to limit its activities to activities of a national bank. So you can only do what a national bank does, but you don't get to have insured deposits. So that seems like a dead end for me. So then, well, what's the point? Well, the point has to be federal preemption. And obviously that's important. But I do think that there are forces that have eliminated some of the benefits of federal preemption. We have a lot of state efforts to coordinate differing state licensing requirements, et cetera. There is the problem of usury laws. So maybe that's a big state usury laws. So maybe that's a big motivator. But I think federal preemption has to be one of the only drivers behind this. Perhaps it is also the ability to get Fed member services. I'm not clear on whether this special purpose national bank charter will be entitled to member bank Federal Reserve services. So to be sure, the elimination of the deposit-taking aspect of the special purpose national bank charter is really key in two ways. So why is it that that's so important? It's so important because by eliminating the deposit-taking piece of this special purpose bank charter, we eliminate Fed supervision. So that means not having to deal with some very key centerpieces of Fed supervision, like source of strength, the holding company acting as a source of strength, to the affiliates, or restrictions on cross-selling, which I would think would very likely be important to some of these FinTech firms. Also, very important is by leaving out the deposit-taking arm, we potentially avoid problems with affiliations with non-banking entities. And of course, that's going to be very important to a FinTech firm that has any notion of later being acquired by investors. So this gets me to just a little piece of history that I'd like to share with you, because to the extent that this avoidance of Fed supervision and avoidance of the rules on combining banking and commerce, that gets us to the Bank Holding Company Act of 1956. And I just want to do a little bit of history because I think it plays well into some of the things that David is looking at. So the separation of banking and commerce comes primarily from this 1956 legislation. And as I always tell my students, never forget to look at definitions. There's a lot of law in the definitions. They like to sort of skate over the beginning of a statute where all the terms are defined. But this is a great example of that. The definition of bank under the Bank Holding Company Act is key to this whole process. So the definition of bank is key because you're not going to be a bank holding company unless you own a thing called a bank. So we have to know what a bank is. It should come as no surprise that since 1956, the definition of bank has been amended many times because of this constant struggle between allowing combinations of banking and commerce. And for those non-banking people, when banking people say commerce, they mean anything that's not banking. This combination of banking and commerce, or this separation of banking and commerce. So I did a quick review and found this. So the statute was passed in 56. In 1966, the definition of bank was narrowed. In 1970, it was narrowed again. In 1987, it was expanded, but several institutions were grandfathered as exceptions to the definition. In 2010, I just thought I should mention Dodd-Frank, even though it really didn't deal with the definition itself. But in 2010, Dodd-Frank put a moratorium on the chartering of any new firms that fell within one of the important exemptions, which I'll get to in a minute, which is the industrial loan companies. So, I mean, I've also left out all the changes to the statute that related to thrifts and the definitions that relate to their holding companies. So I'm sort of ignoring them for the moment. So what's interesting is if you look at the 1956 definition of bank for purposes of the Bank Holding Company Act, I think it would cover fintech companies, even as they're these special purpose national banks as they're currently envisioned. So it's only because of changes in that definition that we really can eke out this space that the comptroller is trying to fill. The current definition focuses on deposit-taking institutions, and with certain exceptions for credit card banks, trust banks, industrial loan companies, credit unions, and some others. So that's why the deposit-taking piece is so important under the current definition. Now, let's keep in mind that these exempt institutions that look like banks, but do not cause their holding companies to become bank holding companies, currently occupy a very small portion of the banking industry. So we're not talking about the tail wagging the dog or anything. Most institutions that we think of as banks, when they're owned, they are owned by bank holding companies. So with regard to the exempt institutions, one other thing before I conclude. The Dodd-Frank moratorium on the chartering of new industrial loan companies expired. And interestingly, there have been recent applications with the FDIC by SoFi and Square, but have both been withdrawn. So in some ways, we see a little bit of what David has been talking about over at the OCC. So what does all this history suggest to me? It sort of gives me at least some template to think about what might happen with the OCC's Special Purpose Charter. If I had to guess today, and obviously I could be wrong, I really can't see that the Special Purpose Charter is going to have a significant impact going forward. I see it as much more like the experience that the FDIC has had with ILCs. And while ILCs have the advantage of being able to offer deposit insurance and still not trigger the separation, the ban against combining banking and commerce, the special purpose bank does have the advantage of probably broader preemption than these state ILCs do. So, but I see them probably falling in a similar category. I think that despite Tom's efforts, the OCC might be a little bit late to the party. I think states have done some efforts at coordination. And there are a lot of affiliations between fintech firms and existing banks. And so there may not be a huge need for the special purpose charter. Now, if I'm wrong, and the OCC in the next few years starts to see lots of interest in this new charter, in addition to the litigation that I'm sure they will experience, if the program is successful, and if we look at the history of the Bank Holding Company Act, I wouldn't be surprised if Congress was forced to consider closing whatever loophole that is seen to create in the Bank Holding Company Act, particularly if two things happen. If any of these special purpose national banks become controversial, like Walmart's bank became controversial, and therefore created all the problems for industrial loan companies, or if the big banks simply don't want it and put pressure on Congress to close that loophole. That seems to me to be very consistent with the history associated with the Bank Holding Company Act. On the other hand, I suppose it's possible that Congress could, sort of as David suggests, embrace the special purpose national bank as an opportunity to experiment with dismantling the separation of banking and commerce by excluding them from the definition of bank under the Bank Holding Company Act. And I think that would be a very interesting debate to watch. Thank you.
Thank you so much, Heidi. Now, Tom Abatanian, who joined the school in 2018, is a new member of the law school family after a great career at Deckard as a banking law lawyer, is a prolific writer despite being a very busy practitioner. So, Tom, the floor is yours.
I started the trend.
Keep myself interested. Powell, thanks for having me and asking me to walk down the hall to speak. David, thanks for that terrific piece. It's a great compendium of law that I think all practitioners have probably been looking to have in their library, so I appreciate it, and it was very thoughtful and thought-provoking. What I'm going to do here, as the cleanup hitter, particularly since you didn't say anything about my baseball career, but I'm leaving tomorrow to go to Florida to play in the Roy Hobbs World Series of Senior Baseball for the 25th year in a row. And Andy Sandler used to be my center fielder, you know. And anyway, what I'm going to do as a cleanup hitter is just sort of pick out some of the kernels that I'd heard here and respond a little bit to them, because I think it's been very interesting. And Heidi, you made a point I've made to my students many, many times. In 1978, when I was at the controller's office, I was asked by the controller to write the regulation on leasing of personal property, which was, of course, leasing of cars, which had just become more in vogue than actually buying and selling cars. So it started in that period, and the national banks, particularly Seattle National Bank, wanted to get into the business. And I was asked as a brand-new lawyer at the controller's office to write the regulation. And what I learned pretty quickly in that and the dozens of regulations I wrote after that, either there or at the Federal Home Loan Bank Board in the thrift crisis, was that it's all in the definitions. Because I learned that I could repeat the statute word for word and make everybody happy that we had stayed true to the theory and the concept of the statute. And then by defining every term in that statute, completely changed the meaning. And so what I've always done as a practitioner, and what I've been telling my students do, is to make sure you understand the definitions, because things can really change. But so I'm intrigued by a number of things that the whole chartering and licensing phenomena raises. And I actually worked on some chartering of national banks in the 70s when I was there, and I ended my legal career 40-something years later working with the control rules, trying to structure private equity and hedge fund investments in failed banks. And it's sort of the mirror image of the same thing. You know, who gets in? Who gets a key to this club? And there are lots of reasons why those keys are jealously withheld, because largely of federal deposit insurance, right? That's the line you draw, federal deposit insurance. Because what else is there if it's not federal deposit insurance that really says this is a privilege for which you have to qualify. And so that raises some interesting questions in my mind, particularly given what FSOC has been doing with, or at least now it's in reverse, but what it was trying to do, applying prudential regulation to non-banks, because that's the first time we have ever tried to apply prudential regulations to companies that didn't have FDIC insurance. But put that aside for the second. So commerce versus banking. I'm just continually intrigued by this. When I started as a banking lawyer in 1976, I was told, it's all about commerce versus banking, and Glass-Steagall was being debated every year, and Congress was raking in the money from the debate over Glass-Steagall year after year, and which is probably the reason why it got debated so long, I think, at the end. But if you go back and look at any crisis in the last 120 years, it wasn't caused by commerce versus banking or any blending of commerce versus banking. In fact, if you look back over that period, the major crises in the country and perhaps the globe were caused several times by mortgages and mortgage lendings, a few times by foreign lending, and also agricultural lending in the 50s. And I can't find a case where the blending of commerce and banking caused a collapse, but it makes for interesting theory and it makes for an interesting slogan. And so if you assume that slogan is not empirically correct, well, then you come to the licensing and the chartering issues a little bit differently, it seems to me, because there's two things I'm hearing. Number one, we ought to apply the laws very stringently and not get out of the mold that puts banks in the business of commerce or commerce in the business of banking. And I don't see that FinTech effort as that, but I see the argument that people make. On the other hand, it seems to me all the development in this business, in the financial services business over the last 100 and something years, has been by shaking it up and in technology, forcing it to go to the next step. So it seems to me fair and equal, perhaps, to let the market decide whether FinTech banks are going to make it. Because frankly, at the end of the day, and Tom, I'm sure you would agree with this, FinTech banks are going to be regulated as banks. They're not going to get any special privilege and be able to slip around the corner or behind the door because they're FinTech. They're going to be regulated by banks, which gets to the question Heidi raised, which I ask myself all the time, who needs this aggravation, right? I've spent 40 years putting people in the banking business and telling them, are you sure mortgage banks, how many mortgage banks have come and said, we want to buy a bank so we can put our mortgage business through the bank because of preemption and deposit insurance, we get cheaper funding, all those things. And if they actually get through the process, and if you actually cannot convince them that this is the best thing to do, because I've always told clients that if you give your mortgage origination business to this bank, you are effectively giving it to the United States government because you don't get it out until the United States government tells you when you can get it out, right? So the question of who wants to do this I think is fundamentally important because at the end of the day, I think most of the FinTech companies are going to decide they don't want to do it. They don't need that aggravation. They don't need that regulation. I mean, look how many companies spend their lives trying to outrun the Federal Reserve Board and not be a bank for bank holding company purposes. The fact of the matter is the definition of a bank for bank holding purposes has nothing to do with the definition of a bank, which is not in the National Bank Act. And that's sort of left to the controller. And so I think at the end of the day, I don't see a lot of FinTechs, maybe unfortunately, but I don't see a lot of FinTechs going for this charter and buying into the regulation because anybody who's practiced knows, and anybody who's been in the business knows that entrepreneurialism and banking doesn't mix. It just doesn't mix. Those two types are completely different in terms of their style and culture. So I'd be interested to see if this really does take off. The last point I'll make is one about the public policy of state versus federal regulation. In 1982, after we had done at the Federal Home Loan Bank Board about 50 interstate and inter-industry mergers where we were letting anybody and everybody buy a thrift, because we had shut down the chartering process, and basically the message to the business was, if you have capital to put into the S&L business, you're putting it in a failed one. You're not getting a new charter. Whether that was right or wrong, that's typically what happens in a period of crisis. Regulators want to direct the capital in the direction of the failed companies. I think that process works well. But at that time, after all those interstate and inter-industry mergers, I reached the conclusion, made a speech, saying that this was the end of the dual system of banking, that states and state regulators would have no role in the future because of the interstate nature that banking was going to. Well, that couldn't have been more wrong, because the state regulators have only gotten stronger and more prolific. In fact, today, and I react to the issue that David made about one regulator, I don't think it's possible to have one regulator. I think it's possible to have 52 instead of 78, but I don't think it's possible to have just one regulator. And you talk to any national bank that's doing mortgage lending on a 50-state basis, they've got three different things to consider: federal law, state law, and the state laws they're going to voluntarily comply with because they don't need the aggravation of fighting with 50 states. And so they end up complying with an enormous amount of laws, whether preempted or not, and ending up with an enormous number of regulators. As I say, if you're doing mortgage lending on a 50-state basis, you've got 50 state regulators at the minimum, unless you have 2 or 3 in each state, which may include the securities regulator, the consumer protection regulator, and the attorney general. And so let me come to my sort of ultimate point here, and that is, we're in a business where innovation has to struggle to get its head out front because we've got so many regulations and so many regulators that it's really difficult to figure out how to go through that path. And I find it, as I said, interesting that entrepreneurs would want to do that, but they may. But fundamentally, we are still dealing with the same, in fact, bloated system that was established beginning in 1932, 33, and 34, with the banking laws, the FDIC Act, the Federal Home Loan Bank Act, the securities laws. We still have the same structure, the same regulatory approach that we did then, and our economy and our technology looks nothing like it did in 1932. So I guess where I come down at the end of this discussion is, I think we're arguing and I think we're talking about the wrong stuff. I mean, nobody has considered the chartering business and whether it should be there, how it should be there, who it should be applied with, whether we should regulate companies by what they call themselves or what they actually do, which would be an interesting approach. But fundamentally, and this is my problem with most of the regulation in the last 40 years, nobody thinks about it. It's just sort of knee-jerked into a statute and then a regulation, and nobody steps back and thinks about how the world has changed. And technology has and is going to continue to change that process dramatically. If you have any time over the next 6 weeks, pick up a book called Life 3.0 by Max Tegmark, who's a professor of artificial intelligence at MIT. And just think about how what he says and the impact on society is going to impact financial institutions. It is somewhere between dramatic and frightening. And, so here we are, basically trying to execute laws adopted in 1864 and processes, that I think may long have lived out their day without thinking about conceptually what we're doing and why we're doing it. Thanks.
Thank you very much, Tom. If any of the panelists want to make a brief comment to other people's presentation, please feel free to comment. I have some questions, but if there are questions from the audience, I'll start question from the audience first. Okay. Oh, yes.
Thank you, Adam. As a layman in this whole process, I was wondering about a couple of things. You mentioned the lack of new charters, but did not mention the number of small banks that went under due to Dodd-Frank. I heard something where somebody said, well, we had one compliance officer and 3 guys out selling mortgages. Now we have 3 compliance officers and 1 guy selling mortgages, and we're going under as for the small bank. The other, not mentioned, and part of the mortgage catastrophe was the redlining concept. I think it started in Massachusetts, where the banks were forced to have mortgages in areas of the city, the county, the state, which were, yes, low income, but ended up selling mortgages that could not be repaid, and they knew it, but they had to have a certain percentage of their mortgages from those areas, otherwise the regulators were going to eat them. Any comments from the panel on those 2 ideas?
Well, I would say on the second, or the first, one of your ideas. Yes, it's true. Community banks are less profitable and find it harder to deal with regulatory compliance than do large banks. I think it's fair to say. And so then the question is, why would you ever want to do a de novo bank? So some people think that avoiding the legacy costs, there's an advantage to that. But why open a bank that's almost by definition going to be small when it's hard to be a small bank these days? That's not totally clear to me, but there is, I think, a sense among regulators that the advantage of community banks, not always realized with most of them, is that they can, in the right community, provide services that big banks won't provide. So big banks will take deposits in rural places and funnel them to loans in urban places or wherever it is they do business. So if that's true, maybe there's room for a local bank, and maybe if there's room for local banks in the right kind of place, you want to be able to start one up without, buying a quasi-failed institution. That might be.
No, just to add on what David said, I think the successful community banks find an unmet need or a niche. One of the current areas, small business lending, that they've carved out a niche by providing financial advice along with a small business loan. But looking forward, I think that niche will diminish over time, especially with some of the FinTech products that are out there that have sped up and automated the small business lending process. Up till now, it's been a labor-intensive, hand-holding type of process. With advances in technology, that advantage may be extinguished.
If I could just add about the failure of community banks. The FDIC did a study on community banks. It's probably a little dated at this point, but it definitely looked at the causes of failure of community banks, and it did not find a direct correlation between regulation or excessive regulation and community bank failure. Community banks fail because they take excessive risk or they grow too fast. That's my memory of that report, that those were by far the most salient factors in looking at community bank failure.
Your question is sort of music to my ears. I'll just add 1 or 2 things. Number one, if you go back and look at the last crisis, of the 453 banks, I think, that were taken over, most of them were community banks. That doesn't mean the large banks or everybody else didn't fail. I mean, I think every bank in the country failed sometime between 2008 and 2010. The question is, who could be taken over and who would be taken over? And unfortunately, the community banks were sitting there sort of defenseless in that process. And I think they took the brunt of it. But to say that the other banks in the country didn't fail, I don't think is accurate. Second of all, there's a number of studies out there that show the amount of expenses that have been added on to banks' G&A, and I think it's somewhere between 35 and 135 basis points in small banks. There's a Fed study by the Fed Minneapolis Bank. Lastly, Dodd-Frank is interesting in that if you read it from cover to cover, if you have the time and you can stay awake, I think what it says in between the lines, if there was sort of somebody doing commentary, it would say, we hate big banks and we're going to make it extremely difficult for small banks to operate. So I look at it and I say, well, what's your philosophy of financial services in this country if you read Dodd-Frank? And it's just absolutely nowhere. And lastly, I don't think regulation should be in the business of interposing itself where it doesn't need to be. And unfortunately, it has so often over the last 60, 70 years. And each time it does, it causes or facilitates some sort of crisis. And Tom and I were talking about the savings and loan crisis is a great example of a crisis caused by federal government policy, not by greed or bad activities by savings and loan executives. You go back to 1966 when Reg Q was enacted, and you can draw a straight line between 1966 and 1989 in terms of what happened and how the DIDC came in there. Talk also about the early 1990s when the administration and the banking agencies were compelling financial institutions to lend to a broader swath of individuals, low income, moderate, low income. Say what you can or say what you will, that does sort of raise underwriting questions, which some have argued came back to haunt us in 2008 and 2009 when everybody got on the bandwagon of subprime lending and how that could make money for everybody, from the plumber who was putting plumbing in the house to the investment banker who was selling more and more mortgage-backed securities. So I think your question is fundamentally about government social policy that's engineered through banking laws, and I guess the answer is it's done pretty badly.
Thank you.
Yes.
Yeah, I was just going to say, I'm a banking practitioner here in Washington, and I think we represent a pretty decent slice of the so-called FinTech companies, both on the lender and money transmitter side. I'm not sure I'm aware of that many of any size who aren't considering a bank charter. And it's not because having a bank charter is so great, it's because the state regulatory structure is so terrible. Okay? And so I think everyone has to kind of consider the state regulation and the state licensing process, and if you're a mortgage lender, the loan officer licensing, individual loan. We have clients who spend literally millions of dollars a year having loan officers licensed individually, where if they became a bank, their loan officers would be registered, and that cost would just go away. Which is a pretty extraordinary. I mean, there are some big differences, and if you want to launch a national product that's a small loan, well, in this state it's up to this percent, and you can't have this feature, and you can't have that feature, and it's like it's almost impossible to run a uniform product, and you certainly don't have uniform rates, and so the uniformity of operation to make it not incredibly complicated. I don't know if you guys know, but the big finance companies used to have a separate entity in each state. There was Household Finance of Indiana, Household Finance of Illinois. I mean, it's like they really operated like that. They really operated as kind of individual state level companies, and that's a crazy way to do business, right? And so the idea of having a bank charter, and the reason why all the bank partnerships are so, why does everyone operate through a bank partnership? Because basically, who wants to give that many basis points away to somebody who isn't really helping you? Guess what? It's because you need the bank. The bank charter is so valuable. And so what I've not normally heard in academic discussions is just what a frightening nightmare the state licensing and regulatory structure is, and that's something that needs to, and the state regulators have been saying they're going to address it for decades at this point, and it's only metastasized in the 2 decades I've been doing this. The other thing is, we do quite a bit of work with UK fintech companies where they encourage, they say, hey, financial services is good for our economy. It helps businesses grow, helps consumers do things. And when you start describing what it's like doing business in the United States, they can't even believe that we're not Uganda or something like that, that a real country like the United States has a structure the way we do. And it's not that it's corrupt, right? Where, it's just that it's just insane.
It'd have to, I mean, I was both a state bank supervisor, supervised a host of different type of financial licenses, and, certainly on the federal level at the OCC. You're absolutely right. There's a lack of a single platform, I think is a driving business consideration and looking at a FinTech charter. I was actually chairman of the Conference of State Bank Supervisors 18 years ago. And the problem you have, I think they've done a great job in terms of Vision 2020, trying to smooth out the differences. And I was bank commissioner during the post Graham Leach Bliley, where you had nationwide banking. And the fundamental question is, how willing are you to actually entrust your job to another state bank supervisor? And, coming from Massachusetts, I'll play nicely with everybody until it counts. At the end of the day, I would do what's best for a Massachusetts citizen. And just because, pick a state, Nevada happened to be the lead supervisor, I'm not going to go along with it. So you run, I think, a practical risk not being in a federal regulatory environment of being whipsawed, and usually when it counts.
I think your points are extremely valid in terms of the aggravation from the state. And I guess the way I've always looked at it is you got to pick your poison, right? And you can either put up with all that state regulation or try to get federal preemption of some of it, and I don't think you can always get all of it. But the fundamental difference, and what I was trying to say is the fundamental difference is that if you move from licensing to chartering, and you want to run the business through a bank charter as opposed to getting licensed to do it, you really are putting all your eggs in the basket of the government, meaning that business belongs to them until you figure out a way to get it back. So you're sort of putting your business in that charter, and you're renting the right to that business until you figure out a way to get out. And if you don't, or if you don't have adequate capital or this or that, you're going to lose it. And I think that's the big difference. And it's what I always tried to tell the entrepreneurs and who thought that this was an imaginative way to get to the next step, that it may not be. Because the second part of that is, culturally, many of them, and I put the FinTech pioneers in this, they are just incapable of being regulated by regulators. I mean, it's just not mentally or constitutionally possible for some of them. And if it's not possible, they shouldn't get into that business. And that's, so I think your points are extremely valid, but you gotta balance all of that and make your decision about what you can do and what you can't do.
We have one question here in the first row, and then there.
I have a question which is sourced from my naivety. I was a little bit surprised to say that a government official can judge me on whether I'm an appropriate bank person. How well do you think that situation has worked? Have you really excluded the bad guys or the incompetent guys? And do you have any effective guidance as to why you think I'm either good or appropriate or not appropriate? And are there any safeguards that, from abuse of that, where you say, well, I'm of the wrong political party, or I've taken my abortion stance is no good, so you're not going to permit me to have access to this? Are there effective safeguards against abuse, and where to get the expertise at the inception to evaluate private people?
I'll just say briefly, this is an interesting question. I've talked to a few lawyers who have gone through the chartering process, and it struck me also as very surprising that they spend a lot of time looking at your business plan. Like, what do these guys know about a business plan? But they're experienced in banking, and I think a lot of the lawyers said that one of the things they're looking for, in addition to experience and capital, is a sort of diversity. That you're not just in one business, that if it goes south, it's going to be it for your bank. And this is a problem for fintechs, right? If they're all loaning to millennials or whatever, then the regulators might not see the sort of diversity of income streams that they want to see. So I thought they'd be maddest about that. I haven't talked to everybody, and I'd be interested to hear what you guys say. And the ones I talked to weren't outraged by the federal review of those business plans.
As to the character, I mean, basically, it's a background investigation, making at the first cut that you don't have any criminal or other abuse of trust type of transgressions. Then it's really, do you have a team and a board that has the appropriate areas and level of expertise to run a bank? And one of the points I didn't make earlier, I mean, at the end of the day, Tom said this, a FinTech SpecialPurpose Charter bank is a bank. I mean, at the end. So that's the same standard that would be applied.
You know, the intellectual and the integrity criteria that are set forth in the statutes for entrance into the business is sort of the same that are set forth for control standards also. And they go back, and again, it's another knee-jerk sort of reaction that hasn't been evaluated in I guess, since 1977 when the law was passed. But for those of us who are old enough in the room to remember when Jimmy Carter came in, he appointed Bert Lance to be the director of OMB. Bert Lance, in his hearing process, bubbled up all this trouble he had created and violations of law that he had purportedly been involved in at a bank he ran in Atlanta, Georgia. And Congress shooted him back to Georgia and got rid of him quickly. He didn't get through the confirmation process and immediately passed the Change in Bank Control Act, which had all kinds of bells and whistles about what you have to do to take control in a bank. And I've always argued that they are obsolete and probably counterintuitive because fast forward to 2010, in the middle of the largest crisis since the Great Depression, there were, I'm going to say, maybe 3 or 4 dozen major private equity hedge funds lined up to make investments in failed banks, right? And they understood the control rules. They understood they couldn't go over 25%. They understood that they had to play by the rules. And even then, the FDIC puts out a policy statement saying, your money's not welcome. And that just struck me as so counterintuitive and so ridiculous that, those things happen in the business. And again, I don't think anybody's thinking about it. I just think we're reacting all the time, and it's not the way to run the largest economy in the world.
Our last question?
So, good afternoon. Thanks for being here. Looking towards the future, this is to the panel, I'd like to ask you to comment on the emergence of technologies such as blockchain, which enable the creation and support for currencies, non-state-based currencies. And what are the implications for that from a banking and finance perspective? And Tom, building your comment around, entrepreneurs and banking do not mix. When that's the case, entrepreneurs are going to find a way around it. And I think that's part of what we're seeing in the emergence of these, and I actually don't like the term cryptocurrencies. They're just currencies. They're repositories of value over time. So would you comment on that emerging space?
Yeah, let me start, because it reminds me exactly what happened in the late 1990s with the emergence of Mondex, DigiCash, and electronic money then. It was very similar, and they were built on the same technologies. And at that point, I was the chair of the American Bankers Association, American Bar Association, Cyberspace Law Committee. So I got to see a lot of this stuff firsthand. I went over to Swindon, England, to see the Mondex electronic smart card experiment, which got a lot of fanfare, and everybody thought, well, that's the future tomorrow. It's not often the future. And what we learned in that process is a few things. Number one, that just because a technology exists doesn't mean anybody wants to use it. Some of those products that came out in the late 1890s just never made it. Now, the underlying applications and technologies lay dormant, and they've now come up again in the form of cryptocurrencies and blockchain and the like. But just because they're there and the product hits the market doesn't mean anybody likes to use it. And the other thing we learned is John Reed, in a speech he made in, I think, 1998, when he was the chairman of Citibank, said that people think technology is going to overwhelm banking tomorrow. It's going to take 50 years. And the reason he said it will take 50 years to change the business is because every human being has an emotional relationship with their money, and they tend to change their habits very, very slowly, and it becomes generational. So your generation banks one way, your next generation will bank another way. And so I think what we're seeing now is a great technological experiment, and some of that stuff's going to work, and some of it's not going to work. I have not seen yet a cryptocurrency that's actually being used as money in a broad-based fashion. But what I do think is going to survive, no matter what, is, and I think the markets ought to be allowed to play this out before regulation, douses it. But what I do think is going to survive is blockchain, because if you look at blockchain, you understand how it works and the hashing and the cryptography. What you understand is it's going to be a basic application for online commerce in the future. It's got to change a little bit, and proof of work standards probably aren't going to make it at the end, but it is going to be the application that I think a lot of commerce is going to be based upon. And I think that's why the regulators are sort of stepping back a little bit and not stepping all over this stuff. Because I remember in 1998 having a meeting at FinCEN on DigiCash, which was supposed to be the first anonymous money on the face of the planet, because it was created anonymously through a hashing and all kinds of things. And I remember having a meeting at FinCEN where they said, this currency is going to become legitimate and over our dead bodies. And I think they were pretty serious about it. Now, from a market point of view, I wonder how many currencies can make it without a central government or a central bank behind them, right? Because in the sign of trouble, what happens? They disappear like that. But, I mean, I think this is all sort of the market churning up development. And I think we ought to be looking not at the individual products that we see today, but what's the kernel that's going to succeed and make it over a longer period of time?
Adam, you have a question?
Can I build on that question? I had a question to ask, and if you don't mind, just an extra minute. I'm just curious, looking out into the medium term, 15, 20 years, that was a very general way of putting it, but do you think there'll be more FinTech innovation in, generically speaking, like Silicon Valley and the West? Or do you think more of it will come out of Wall Street, where Wall Street, banks and sort of the traditional money center companies will actually build up this technology themselves? And where do you think more of this innovation is going to come from in the medium term? And do you think that's driven mostly by market realities, or do you think it's in part by the regulatory environment?
I mean, I'll say that when I read about this, it seems to me that Wall Street's where lots of the FinTech action is. That even though you get a sense that some of the Vero is based in San Francisco or whatever, but a classic exit route for my former students is getting out of the bank, and now they're going less to private equity and hedge funds and more into FinTech startups. But they are always starting at bulge bracket banks in Wall Street.
I think the largest banks are going to be a major player. I think if you look at the hype around FinTech, originally it was the usurpers. They're going to crash the model. You're seeing more and more that it's joint ventures, acquisitions. Longer term, I think if the banks play it right, they'll still be major players in FinTech.
Yeah, I think Tom's exactly right, because I think what's going to happen is every startup that makes it is going to be bought by a bank. I don't know how they survive if they're small. Now, maybe if Amazon, comes up with a technology, they'll be able to keep it. But the banks have been shown a lot of great talent in terms of joint venturing with a technology or a new product, or just buying it straight out.
And it's a small slice of financial technology, but I'm working on a study right now that looks at banks' patent activity. And traditionally, banks had almost zero, but that's been very different in the last 20 years. And the larger banks are almost as active in a certain type of business patent as some of the big Silicon Valley firms. So I think the big banks are very serious about it.
Well, I want to say thank you very much to Paolo and to all of our speakers. And we're so grateful at lunch to have the recent FTC commissioner to sort of reflect on her government experience. In the same way, Mr. Curry, thank you so much for joining us today, for offering your insights. And thank you to everybody. Thank you very much.